Hello everyone, this is Shlok, and in the second part of our economics journey, we dive into new concepts that would help us confidently approach discussions in the realm of economic policy or government decisions. With that said, I would urge you to watch the first part of this video because this is going to be essentially a continuation of the first one. So with that said, let's get started. Looking at the first topic of discussion today, how does the Reserve Bank of India control inflation in the economy? Now I know we've already discussed money supply and how RBI controls the money supply using the repo rate. But in addition to repo rate, there are a bunch of other tools as well, such as there is reverse repo rate, there is the cash reserve ratio, which I've abbreviated as CRR, then there is the statutory liquidity ratio, which is the SLR, and finally there are open market operations. So these are the other tools in addition to just repo rate that the RBI can use in order to control the money supply and in turn the inflation in the economy. So we'll be outlining all of these different tools one by one. So the first tool that we'll be looking at today is the reverse repo rate. Now what is this and how does this relate to the repo rate? We've discussed the repo rate is essentially the rate at which the RBI lends money to commercial banks. This reverse repo rate is essentially the opposite. This is the rate at which the RBI takes money from the commercial banks. This is the rate at which the central bank takes money or borrows money from the commercial banks. And how does it do that and why does this matter? So the reverse repo rate, if let's say your reverse repo rate increases, now if I'm a commercial bank, let's say I'm an HDFC bank and the RBI increases the reverse repo rate. Now if I lend my money to RBI, that is, first of all, you need to understand that is a very safe investment for me. So if in a safe investment I am getting more returns, I will be inclined towards making that investment. So if the reverse repo rate goes up, commercial banks will be more inclined to give that money, to lend that money to the RBI. Once you lend that money to the RBI, you won't be able to lend that money to normal people like you and I. And what would that do? That would reduce the money supply in the economy, and that would overall lead to an impact on inflation, a downward impact on inflation. So that is the first impact that you need to understand. And a vice versa would happen in case the reverse repo rate goes down. In that case, it becomes less attractive to lend to the central bank. And in that case, you would want to instead loan out to normal individuals and businesses, and you would want to take more risk in order to gain more return. So that is the first aspect, the reverse repo rate, which is the opposite of the repo rate. The next two tools, which is the cash reserve ratio and the statutory liquidity ratio, sort of go hand in hand. Let's just break down the first one, the CRR. What is the CRR? The cash reserve ratio. It is essentially, let's say I'm an HDFC bank, and the cash reserve ratio means that what out of my total deposits, let's say I've gotten 100 or 1,000 rupees from the public, and these are this is the total money that the public has deposited with me. Now the cash reserve ratio tells me that a certain percentage of this entire thing, let's say 10% of the entire deposits, which is 100 rupees, I need to deposit with the Reserve Bank of India. So that is the cash reserve ratio. If your cash reserve ratio goes up, I'll have to deposit more money or keep more money reserved with the Reserve Bank of India because it's a statutory requirement. And what that would do is that would restrict the money supply in the economy because that money is no longer available with me to lend out to common public and the businesses. So that is the cash reserve ratio. The SLR is similar to the CRR, but in this, I don't need to give my money to the RBI in bare bones terms. Instead, I could invest that money in government approved securities or any security that the RBI tells me is compliant with the SLR policies. So this again works in a very similar fashion as the CRR. So CRR and SLR, similar concepts you need to know about. The next tool that the RBI has is open market operations. So before you understand open market operations, you need to understand what government securities are. They are fairly straightforward. This is a particular way through which the government takes money or borrows money from the public. So let's say the treasury bills are one form of government securities. So now the RBI buys and sells these government securities in order to control the money supply in the economy. How do they do that? Let's say I'm the RBI and I want to let's say reduce inflation. I want to reduce the money supply in the economy. What I'll do is I will sell government securities. And if I sell government securities, that means I'll get the money from public. That will reduce the money supply in the economy, indeed reducing the overall inflation rate. and the vice versa also follows. So this is a little bit about the open market operations, essentially meaning that RBI goes into the open market and does its buying and selling in order to control the inflation. Let's move on to the next important topic, which is what are the different kinds of market structures. Now, why is this important? If you've mentioned anywhere marketing or pricing in your application, you need to be able to have a strategy for pricing, and the kind of market that you operate in determines the kind of pricing strategy that you will be using. With that said, let's look at each one of these one by one. Now, let's take a look at the first type, which is perfect competition. How do we understand this? We, imagine that you walk into a market of vegetables and they are all just selling tomatoes. And what happens is everyone is selling at the same price. You go to the first stall, they say 20 rupees a kg. You go to the second stall, they say 20 rupees a kg. Why exactly is this happening? So this particular market works on a fundamental assumption, which says that all the units in the market, be it buyers or sellers, have all the knowledge there is to know about this one particular product. So everyone sells at the exact same price, because if everyone tries to deviate from their price, no one would be willing to buy their product, because everyone has something called perfect knowledge, which is all the knowledge there is to know about this market. So this is what happens, that everyone sells at the same price. The product is homogeneous. Everyone is selling the same product at the exact same price. So this is perfect competition. Coming on to the next one, we have a monopolistic competition. Now, what exactly is a monopolistic competition and how is it different from a perfect competition? So as we go along, from the left towards the right, what would happen is the number of sellers in the market would go on decreasing, and the amount of differentiation, what do I mean by differentiation, is the amount of difference that you can create between you and your competitors increases. For example, in a monopolistic competition, there are still a large number of sellers in the market, but they can differentiate themselves from their competitors. For example, you can look at, let's say, the smartphone market. Even though there are a lot of sellers, there is Oppo, Vivo, Apple, Samsung, they all have their distinguished, particular characteristics with which they are able to differentiate their products. So this becomes sort of a monopolistic competition market. Previously, it was an oligopoly of sorts, but we'll come on to that later. But for now, you need to understand that there are still a lot of smartphone manufacturers in the world, and that is something that creates a monopolistic competition. So in a monopolistic competition, you still have some control over your pricing, because you can differentiate your products from your competitors, which wasn't the case in perfect competition. So this is one thing to keep in mind. Now you go to an oligopoly. What exactly is an oligopoly? Oligopoly is even less, your number of sellers become even less, maybe 3 or 4 big players in the market. One such example could be the Indian, telecom industry or the internet service providing industry. And here we just see a couple of or 3 players at most. There is Jio, there is VI, there is V, that is, there is Airtel, and BSNL is not really that prominent of a player anymore. So this is an oligopoly. There are just a bunch of players, and they can dictate the prices according to their needs. The automobile sector can also come under the oligopoly. So as you go from left to right, the amount of control that the seller has over the pricing of his products keeps on increasing, and the buyers, they have lesser and lesser control over the pricing, because they only have limited options when it comes to buying a product. Finally, coming on to a monopoly. What is a monopoly? Mono means single. So there is only a single seller in this particular market, and mostly these things, they're considered bad. For example, Google has a monopoly in the search engine business. Meta, in a way, has a monopoly in the social media business. In a way, not absolute monopoly over there. And the Indian Railways has a monopoly in the Indian railway market. So these things are considered to not be a very advantageous position for the consumers, because the seller does not have any competition that they need to meet in order to match their prices, or they don't even need to compete on the quality of service. So this is one type of market that I wanted to discuss about. All right, summarizing our discussion on this particular topic, why is it important? Let's say you are coming from an entrepreneurship background, and let's say the panel asks you, what kind of market structure does your particular product fall in, and then you have to comment on the pricing of that product. So let's say I'm in the event management business. That could be said to be a monopolistic competition, and that means that I have a certain level of control over my pricing, but I also need to keep in mind the level of competition, and I also need to match the pricing in the market. So that is some level of self-awareness that I have about my product. Let's say you are going into an interview. You also need to have this kind of awareness about your product and the pricing strategies that you need to accommodate. Now let's move on to the next group, crucial topic, which is what are the different kinds of economies and why is this relevant from an MBA interview's point of view. So the first aspect over here is the socialist economy. Socialist economies essentially mean that you have government ownership over all your resources. There is not enough motivation or incentive in order to make a lot of profits because there is essentially high taxation, and what the government aims to do is there should be equitable resources or equitable distribution of resources. So that is about the socialist type of economies. And capitalism is essentially the opposite. Government keeps its influence to the minimum. It wants private enterprises to take over, and it requires them in order to make the most profits that they can possibly make. So capitalism also gives that incentive to entrepreneurs in order to do well, to innovate. So capitalism leads to a lot of economic growth. All right, now why is this important from an MBA interview's point of view? This gives you a sort of historical context. First, we need to understand that the Soviet Union was a socialist republic back in the day. Then what happened when India gained independence? We were in a flux that should we adopt the Soviet way of life, which is a socialism, or we should go with the US and adopt capitalism. And then what did we choose? That is an important thing that could come up in a discussion or in a group discussion or a discussion with the interviewers. That is something that can come up. We need to understand what the Cold War was about. That was essentially a war between different ideologies. There wasn't essentially an actual war that happened, but it was an ideologies war. For example, the socialist versus the capitalist ideologies. So these topics, in order to understand these topics, we need to get our fundamentals right. We need to understand what is the difference between these two essential sort of types of economies. With that said, I also wanted to talk about what is the kind of economy that India really mainly functions upon, and we mainly operate on a mixed sort of economy where private enterprises have especially taken the lead, especially after 1991. But there are still a few sectors where government has kept its influence. For example, there is banking. We still have a lot of nationalized banks. We have government influence in railways and so on. And a lot of countries follow this similar approach, wherein they keep a few sectors within the control of the government, but they try that there should be maximum involvement of the private sector in order to encourage efficiency as well as encourage a lot of innovation and incentive driven production in the economy. The next topic for the day is what are the different kinds of deficits, and there are more than two, but I'm only going to be covering two in this video. The first one I want to get into is what is a revenue deficit. Now, revenue deficit is the difference between your revenue expenditures and your revenue receipts. Now, what are revenue expenditures and revenue receipts? I need you to understand that these are the receipts or expenditures that do not create assets or liabilities. These do not create commitments in the form of long-term payments, or these do not even create assets for the economy. So an example of a revenue receipt would be something like, so an example of a revenue receipt, which would be the form of taxes, would be in the form of taxes that the government receives on a day-to-day basis. And an example of a revenue expenditure would be, let's say, tax, or would be the salaries of government employees that are paid. So any form of expenditure, for example, in building metros or bridges, that is not revenue expenditure because this is creating assets for the economy. And on the other hand, on the form of receipts, if we look at, let's say we take a loan from the World Bank, that is not a sort of capital, that is not a revenue receipt because it is creating long-term liabilities for the economy. So I hope I was able to make the distinction between revenue and revenue receipts and revenue expenditures clear, and I was able to explain what these terms mean. So what does the revenue deficit exactly tells you? It tells you whether your revenue receipts are enough to meet your revenue expenditures or not. Basically, are your everyday income enough to meet your everyday expenses or not, in very bare bones terms. The next one is a fiscal deficit. I need you to remember the very straightforward formula, which is total expenditure minus your total receipts excluding borrowings. Now, total expenditure includes all forms of expenditure that is regular in nature, or it could be something that even creates assets for the government. So all kinds of expenditure comes under this, minus your total receipts. Now, these receipts are excluding your borrowings. So any form of receipts that do not involve taking loans from any part of the world comes under the second part of this formula. So overall, when you see what does the fiscal deficit tells you, it tells you what is the amount of funds that you have to borrow from outside your economy in order to sustain your economy and in order to match or in order to honor your expenses. All right, so that's a little bit from my side for this video. I hope I was able to add some value to your knowledge in the economic sphere, and that'll help you gain confidence in your group discussions as well as personal interviews. Now, these are some other topics that I really wanted to discuss, but I couldn't cover in this video. If you want me to deep dive into them, please let me know down in the comment section below. In addition to that, I do want you to do your own research on this as well. With that said, that's a little bit from my side, and bye bye.